So you've got JP Morgan talking about a significant risk of an abrupt sell-off in the bond market. They've talked about gradual increase in bond volatility, deterioration in market liquidity and vulnerable investor positioning, sparking a bond tantrum a la 2013. At the same time, Jan Hatzius, as we just mentioned, at Goldman Sachs, talking about this hall of mirrors and the risks of that taking the funds rate far away from the level justified by economic fundamentals. Are we getting set up for a real backup in yields?
I think the bond market is extremely vulnerable at the current juncture. I think it's worth standing back and trying to make sense of all this confusion. You're getting so many different opinions, people trying to over forecast, I would say, and be way too specific about what they think is going to happen, what might happen. I think the fundamental observation I'd make about the world is that everybody, central bankers, market participants, are repeatedly exaggerating the probability of recession, and the reason for that is mental scarring. Is everybody still remembers, it was just brought up in that quote that you just showed, the great financial crisis, 2008. So anytime you get any moderation or slowdown in the economic data, there's a kind of collective overreaction and fear that this could morph into some kind of disastrous recession, and the market overprices that, and I think you're seeing that everywhere. But I think the key point I would say is when you look at the nature of price action, what you've seen in bond markets over the last 4 to 6 weeks is not a considered reaction to shifts in underlying facts. It's very clearly price driving price, investor psychology and market momentum, and those phases are always very vulnerable as people reassess with calmer heads and they wonder to themselves, why am I buying 10-year German government bonds at a negative yield? And you can get a very, very significant reversal in yield in those conditions.
Eric, good morning to you. Good to see you.
Morning,
you say the
and
bond
you.
market is potentially very vulnerable, and I get that. If you look at some of the extreme moves in Italy, the aggressive positioning in US Treasuries in the 2 years, and the dislocations that we're seeing around the world, what is it that reverses this aggressive move to haven, or indeed this aggressive move in a reach for yield? What turns the story?
Well, again, this goes back to how do you think markets work? How do asset prices behave? You can get a reversal on nothing in the same way that there was very little to explain. I mean, you pointed out the move in Italian bonds. We've actually been long of Italian bonds for the last year. I took that as an opportunity pretty much to close most of those positions. Again, it was not at all obvious that anything fundamentally has changed with respect to Italian fiscal policy, with the outlook to debt sustainability, with the outlook to the Italian political environment, and you can get a 40 to 60 basis points rally in the government bond market. You can similarly get you could easily get a 25 to 50 basis points reversal in global bond yields without anything significant happening. But, you know, if I was to point to facts, I suspect there's a material probability that we see some improvement in the data over the next 3 to 6 months is very plausible. Or the more obvious things, which is you get disappointment with respect to what people expect from monetary policy.